2 months ago, in Phoenix, Arizona, a 33-year-old construction project manager named Brian Mitchell sat across from a mortgage loan officer named Stephanie. His wife, Caitlin, sat next to him. They were applying for their first home, a small house in North Phoenix, $385,000, 3 bedrooms, good school district. Their first kid was due in October. Stephanie pulled up Brian's credit, looked at the screen, tilted her head slightly. Then she said one sentence Brian had not been prepared for. She said, "Your score dropped 32 points this past March. Do you remember what happened that month?" Brian thought about it, tried to remember March of last year. Couldn't think of anything. He looked at Caitlin. Caitlin shrugged. Stephanie kept reading the file. She said, "You closed the Discover card on March 14th, the one you'd had since you were 21. That's almost certainly what dropped the score." Brian remembered. He'd been doing a kitchen drawer clean-out, found the old Discover, hadn't used it in 3 years, canceled it that afternoon over the phone, felt good about it. One less thing. Stephanie quoted them their mortgage interest rate. Then she quoted what the rate would have been with the higher score they'd had 2 months earlier. The difference, across the 30-year loan, was a little over $14,000. That's what one phone call to Discover on a Tuesday afternoon, 2 years before they applied for the mortgage, ended up costing them. I'm Trish, and I read the policies that nobody bothers to explain. So the specific credit card mistake that quietly destroys credit scores between ages 28 and 45. The one Brian made, the one almost every responsible person makes at some point. You're going to know by the end of this video. Plus, the 3 credit cards you should never close, even if you haven't used them in years. Here's the part that makes this trap so cruel. Brian didn't do anything wrong. He didn't miss a payment. He didn't carry a balance. He didn't take on new debt. He did the opposite. He cleaned up his finances. He simplified. He removed temptation. He felt like a responsible adult making a mature decision. The credit scoring system punished him for it immediately. Quietly, 2 years before the punishment actually mattered. This is one of the most consistent patterns in modern American credit. People in their late 20s, 30s, and early 40s, at exactly the age when they're starting to get serious about their finances. Now close old credit cards they're no longer using. They're trying to do the right thing. The math on credit scores is set up so that what feels like the right thing is very often the wrong thing. The damage is invisible at the moment of the decision. There's no error message, no warning, no phone call from your credit bureau saying, "Are you sure you want to do that?" The phone call to cancel the card lasts maybe 4 minutes. The customer service rep is friendly. The card is gone. You feel a small dopamine hit of having decluttered. Then 18 months later, or 24 months later, or 5 years later, when you go to apply for a mortgage, refinance a car loan, or qualify for a higher credit limit, the gap shows up. The score is lower than it would have been. The interest rate offered is higher. The down payment requirement is steeper. The monthly payment for the rest of your loan is more. The actual cost of one poorly timed credit card closure is rarely under $5,000. Often it's $10,000 to $20,000 across a single mortgage decision. From a 4-minute phone call you barely remember. Today, I'm walking you through exactly how this trap works. The 2 specific mechanisms that produce the score drop. The 3 cards you should never close. And the right way to handle unused cards in your wallet that doesn't accidentally torpedo your credit at the worst possible moment. One thing before we get into Brian's specific damage. Your credit score is calculated from 5 components. The 2 that matter most for this video are these. Credit utilization, 30% of your FICO score, the percentage of your available credit you're using at any given time. Lower is better. Closing a card removes that card's credit limit from your available total. If you carry any balance on any other card, your utilization ratio jumps the second the closure processes. Length of credit history, 15% of your FICO score, the average age of all your accounts weighted toward your oldest account. Closing Closing your oldest card doesn't immediately drop the average age. Closed accounts in good standing stay on your credit report for 10 years. But the closed account stops being weighted the same way. And in 10 years, the account drops off entirely. That last sentence is the trap. Closed accounts stay on your report for 10 years, then they vanish. If your closed card was 12 years old when you closed it, at year 10 after closure, that 22-year-old account history disappears. Your average account age suddenly drops by years. Your score takes another hit. Sometimes the biggest hit comes a full decade after the original phone call. This is why the title of this video is The 2-Year Credit Mistake. Most people who close an old card discover the cost 18 to 24 months later when they apply for a major loan. But the full cost of the closure plays out across 10 years of cumulative damage. 2 years is just when most people first noticed. Brian noticed at year 2. Stephanie's quote made it real. Let me show you how it works. The Brian breakdown. What actually happened. Let me reconstruct exactly what happened to Brian's credit between March 2024 and March 2026. March 13th, 2024. The day before he closed the Discover card. Brian had 4 credit cards. The Discover from when he was 21. Limit $4,500. Balance 0. Account age 12 years. A Chase Sapphire he opened at 27. Limit $9,000. Balance about $1,400. Account age 6 years. A Capital One Venture he opened at 30. Limit $7,500. Balance about $800. Account age 3 years. A store card from a home improvement chain. Limit $2,500. Balance 0. Account age 4 years. Total available credit, $23,500. Total balances, $2,200. Utilization ratio, 9.4%. Excellent. Average account age across the 4, about 6.25 years. Solid. His credit score, 768. March 14th, 2024. The phone call. Brian called Discover. Canceled the card. The rep asked the standard questions, accepted the cancellation, confirmed it would process within 24 hours. The Discover card's $4,500 credit limit disappeared from his available credit total within about a week when the bureaus updated. New available credit, $19,000. Same $2,200 balance. New utilization ratio, 11.6%. That single change pushed his utilization from 9.4% to 11.6%. Not catastrophic by itself. About a 6 to 8 point score drop within 30 days. But the bigger damage came from the second component. His average account age, which had been calculated across 4 accounts averaging 6.25 years, was now calculated across 3 active accounts averaging 4.3 years. Even though the closed Discover technically still showed up on his report, the credit scoring algorithm weighted the active accounts more heavily. Combined effect within 60 days, score down from 768 to about 736. That's the 32 points Stephanie saw on the screen. Brian never noticed at the time. He wasn't applying for anything. The score moved silently in the background while his life went on. March 2026. The mortgage application. Stephanie pulled the report. Score was 736. Brian and Caitlin qualified for the mortgage at the 736 rate tier. Had they been at 768, they would have qualified for the next tier down, about 0.375 percentage points lower. On a $385,000 mortgage at 30 years, 0.375 percentage points lower is approximately $80 a month less in payment. Across 360 months, about $14,000 less in lifetime interest. Brian's cleanup phone call cost him $14,000. He didn't know. He didn't have a way to know. Nobody told him. The credit card industry doesn't proactively warn you. The credit bureaus don't either. The only person who can tell you is a mortgage loan officer 2 years later, long after the phone call is irreversible. That's the trap. Not malice, not punishment, just the architecture of the system. working exactly as it was designed. The 3 cards you should never close. After Stephanie explained what had happened, Brian asked her one question. He said, "How am I supposed to know which cards to keep open?" Stephanie had been a mortgage loan officer for 19 years. She'd seen hundreds of versions of Brian's exact situation. She gave him a 3-rule framework that I'm going to give you now. The 3 categories of cards you should never close, even if you don't use them, even if they sit in a drawer for years. Category 1. Your oldest card. This is the one that did Brian in. The Discover from when he was 21, the card that anchored his average account age for 12 years. Whatever your oldest credit card is, even if you don't use it, even if it has a small limit, even if you opened it for a college bookstore discount in 2008 and forgot about it, that card is doing important work in your credit profile. The longer it stays open, the more it boosts your average account age. The day you close it, you start the 10-year clock. Year 10 after closure, it disappears entirely from your report and your average age drops sharply. There is no replacement for an old account. Time is the only ingredient. You cannot manufacture 12 years of payment history. You either preserve it or you lose it. If your oldest card has an annual fee that's bothering you, call the issuer. Ask them to change the card to a no annual fee version of the same line. Most major issuers will do this without closing the original account, which means you keep the account history but lose the fee. Brian should have done this with Discover instead of closing. Category 2. The card with your highest credit limit. The card with the highest limit is doing the most work for your credit utilization ratio. Closing the high limit card creates the biggest possible utilization spike. Brian's Chase Sapphire had the highest limit at $9,000. If he had closed that one instead of the Discover, his utilization spike would have been dramatically worse. He would have lost 38% of his total available credit in one phone call. The high limit card is your utilization buffer. It absorbs your monthly spending without pushing your ratio into dangerous territory. Closing it permanently raises your utilization, which permanently lowers your score until you build new high-limit accounts. If your high-limit card has issues you don't like, fee, weird interest rate, an issuer you've outgrown, first request a credit limit transfer to another card you have with the same issuer. Then close the original card. The total available credit stays roughly the same. Your utilization ratio is preserved. Category 3. Any card associated with a positive payment history you cannot replace. This one matters less than the first 2, but is still meaningful. If you have a card where you've made 4 to 7 years of perfect on-time payments, that card is contributing positive payment data to your file every month. Closing it means losing that ongoing data stream. The closed card's history stays on your report for 10 years, but it stops updating. Lenders prefer current, active positive history over historical positive history. The active card is doing more for your score than the closed one will, even in the years immediately after closure. If you have a card with strong payment history that you don't want to use, the right move is not to close it. The right move is to put a single, small, recurring charge on it, like a $9.99 streaming subscription, and set up autopay from your bank account. The card stays active, the payment hits monthly, your file gets continuously updated positive data. You handle the rest of your spending on whatever cards you prefer. Tasha, the nurse from earlier in this series, who went from 712 to 798, does this with 2 of her older cards. She has Netflix on one, Spotify on the other, both auto-paid. The cards never close, never carry a balance, never tempt her to spend, and continuously feed her credit file with perfect payment history. That's the model, not closure. Strategic dormancy with one tiny active charge. The right way to handle unused cards. Brian and Caitlin asked Stephanie one more question. They had 2 more cards in a drawer at home that Brian had been planning to close after the mortgage closed. She talked him out of it. Here's the framework Stephanie gave them, the same one I'm giving you. If you have an unused card, ask 3 questions in order. Question 1. Is this card my oldest, my highest limit, or one with strong payment history? If yes to any of those 3, keep it open, Set up the streaming service trick. Don't touch it for years. Question 2. Does this card have an annual fee? If yes, call the issuer and request a product change to a no annual fee version of the card. Most major issuers offer this. The account history stays. The fee disappears. Brian should have done this with Discover. If they refuse the product change and the fee is meaningful and the card doesn't fit. Categories 1, 2, or 3, you might consider closing. Even then, time the closure for at least 24 months before any major loan application. Mortgage, refinance, auto loan, major credit limit increase request. The closure damage settles within 12 to 18 months for most files, but you don't want to be in the middle of that recovery curve when you walk into the loan officer's office. Question 3. Is the card with an issuer where I have a stronger card I prefer? If yes, request a credit limit transfer from the unused card to the preferred card. Then close the original. Your total available credit is preserved. Your utilization ratio is unaffected. The account history of the original card still stays on your report for 10 years. This is the move most people don't know about. Major issuers, Chase, American Express, Citi, Capital One, Bank of America, will move credit limits between your accounts on request. The phone call takes about 15 minutes. The transfer happens within 1 to 3 business days. For Brian in March 2024, the right sequence would have been call Discover, ask for a product change to no annual fee. They would have done it. The account stays open. No fee, no score damage. 2 years later, no $14,000 mortgage hit. A 4-minute phone call instead of a 4-minute phone call. Different outcome by $14,000. That's the entire trap, not the closure itself. The closure without knowing the alternatives. 3 objections come up here. Let me handle them. Objection 1. But I have too many cards. I want to simplify. Simplifying your wallet is not the same as simplifying your credit file. The cards you carry day to day can be 1 or 2. The cards you have open on your credit file should generally be all of them, especially the older ones. The unused cards don't need to live in your wallet. They can live in a drawer. They can live in a safe deposit box. They can be cut up so you can't physically use them. The card itself doesn't matter for credit scoring. The account matters. You can have 8 open accounts and only carry 2 cards. Your credit file rewards you for the 8 open accounts. Your daily life is simplified by carrying only 2. Objection 2. I'm tempted to overspend if the card is open. Real concern, real fix. Lower the credit limit on the card to something small. Many issuers will let you voluntarily reduce your limit. A $9,000 card can become a $500 card. The account stays open. The temptation drops. The age of the account is preserved. The utilization math gets less favorable, but is still preserved as long as you have other high-limit cards. Or keep the card open with the full limit, but freeze it. Most issuers let you freeze a card through their app. Frozen cards can't be used for transactions, but stay open and continue contributing to your credit profile. The freeze is reversible in seconds when you actually want to use the card. Or keep the card open and just don't carry it. Put the streaming service autopay on it. Pay that off automatically every month. Don't touch the card for any other purpose. 3 options. Pick whichever your willpower can handle. Closing should be the last resort, not the first. Objection 3. What if the card issuer closes my account for inactivity? This does happen. If a card sits at 0 use for 12 to 24 months, some issuers will close it for inactivity. The closure damage to your score is identical to closures you initiate yourself. The fix, the streaming service trick from earlier. Put $19.99 subscription on the card. Set up autopay from your bank account to cover the monthly bill in full. The card has a transaction every month. The issuer sees activity. The card doesn't get closed for dormancy. If you don't want to do streaming, any small recurring charge works. Spotify, Netflix, a $5 per month app subscription, a $7 per month cloud storage plan. Anything that hits the card monthly and gets paid off automatically. 5 minutes of setup, permanent protection from inactivity closure, forever value to your credit profile. Action steps, 3 steps. This week, none of them require new spending. Step 1. Tonight, the card inventory. Pull out every credit card you have, even the ones you forgot about, even the ones in a drawer, even the store cards. For each card, write down issuer, account opening year, current credit limit, current balance, annual fee, if any. Calculate your total available credit and your average account age. You now have a complete picture of your credit profile. 15 minutes tonight. Step 2. This weekend, identify your 3 protected cards. From your inventory, mark your oldest card, your highest limit card, and any card with strong payment history. Those 3 categories, sometimes overlapping in a single card, are the ones you never close. Tag them, note them. Build the rule into your future thinking. If any of your protected cards has an annual fee, call the issuer this weekend. Request a product change to a no-fee version. Use the script, "I'd like to product change my card to your equivalent no annual fee product." Most reps will process this in 5 to 10 minutes. Step 3. This month, the streaming autopay setup. For any unused card you want to keep open, including the protected ones, set up one small recurring charge. Pick a streaming service or subscription you already pay for elsewhere. Switch the payment method to the unused card. Set up autopay from your bank account to cover the card's full balance every month. The card is now active, the activity is small, the balance is paid off automatically. The card stays open indefinitely. Your credit file gets continuously updated positive data. 3-step, the inventory, the protected cards, the autopay setup, total time investment under 90 minutes, permanent protection of your credit profile. The mistake Brian made on a Tuesday afternoon is not the mistake you make this weekend. If this video helped you, or if you've ever closed a card and felt that small responsible glow that turned out to cost you, do me one favor. Hit the subscribe button. New video on this channel every single day. Each one is a specific move that puts real money back in your pocket, same way this one just did. And here's what's coming tomorrow that I think genuinely separates the people who quietly build wealth from everyone else. Across this entire series, you've met them. Eleanor with her $4.1 million on a $340,000 income. Walter with his $4.7 million quietly built across 30+ years. Henry the truck mechanic with $2.1 million. Margaret, who left $11 million to a small college nobody had heard of. There is one specific thing they all do. One signal. One quiet behavior that almost no other Americans replicate. It is not income. It is not investing strategy. It is not real estate. It is not luck. It is one decision they make every month with the same number, in the same order, without exception, regardless of what life throws at them. About 1% of Americans actually do it. Tomorrow, I walk you through the specific signal, why it matters more than any other single financial behavior, and the exact way to start doing it yourself this month, even if your income is modest, even if your debt is high, even if you've never thought of yourself as someone who could build wealth. If you watch one video in this series, tomorrow's might be the one. I'm Trish. Talk to you then.